I'm Mark Gagan and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go, enabling an enterprise view of exposure. Today's guest can boast a 40-year career in the reinsurance business and now leads a global reinsurer with around $3 billion in gross written premium and approximately 250 employees. Dieter Winkel is president of Liberty Mutual Re, and this podcast is very timely, given its positioning just ahead of the key 1/1 reinsurance renewal season. Dieter is everything you want in a reinsurer: experienced, probably unshockable, and very measured and consistent, as well as being easy to talk to. In this episode, we cover all the major issues affecting the global reinsurance market, from the general state of the market cycle and trends in global specialty, property and casualty, and retro, all the way through cyber, to the burgeoning world of parametrics and the best applications of AI in reinsurance. This is a very enjoyable interview with a consummate reinsurance professional who has lived through multiple market cycles and is an excellent communicator and great company to boot. The next half hour is going to fly past. Enjoy the podcast.
Dieter, welcome to the Voice of Insurance.
Thank you very much for having me.
Anyone who doesn't know you, why don't you just give us a brief introduction of yourself and your career to date and how you've got to where you are now?
Yeah, I'm with Liberty now for more than 20 years. I have had a simple background, actually. I started off with an underwriter. I was responsible for we called it specialty account at the time.
Where was that?
That was at Gerling Global Re, actually, a company that doesn't exist anymore. And specialty at that time was everything that was outside of people's underwriting guidelines. So very different to the definition today.
And that was almost like a direct operation, wasn't it, at the time?
No, it was Gerling was direct and reinsurance, but I was Gerling Global Re, so the reinsurance arm. So I was reinsurance all my career. And Gerling stopped underwriting in 2002. And at that time, I just wanted to continue with the book of business we've had. And I started off with Liberty, actually. And we took that account over. And from there, we developed lots of different areas, lots of different accounts. Started off with Europe, opened up Paris office, had very different teams, not purchased a company, but had very different teams that we brought onto the Liberty operation. And in the meantime, we have roughly $3 billion of income, and it's a broad mix of business between specialty and P&C.
How many people?
We are roughly 250 people by now.
So it's a really substantial operation. How do you want to be positioned in the market? We're in London. If I throw a rock hit a broker on the head, and I ask them, hey, Liberty Mutual Re, what are they all about? What are you going to see them for? What do you associate them with?
Well, I hope the first word that people will be saying is stability and reliability. So I think we are a company that's been around for a long time. I remember the first year when we started it, a new startup sort of thing that doesn't last very long. We are now in the market for more than 20 years. And I have to say the stability is something that is such a critical point in our industry because we have lots of capital coming in, we have capital going out, we have changes, we have market dynamics, cycle management, stuff like that. But you do need reliable partners in this industry because ultimately we're covering long tail and long-term exposures.
You don't want someone who's going to be in and out in a couple of years and then only just got to know them, really, haven't you?
Exactly right.
In terms of classes of business, is it fair to say you do almost everything?
Yeah, we don't do life, for example, but outside of that, for the P&C world, we do specialty lines, and that's probably where we grew up with, and that's the biggest development we've had over the time. But overall, particularly when you mentioned London market brokers sort of thing, I think it's worthwhile to emphasize we are a global worldwide operation.
Absolutely,
the London market is important to us, but it's not the only area where we develop. We have offices all over the place. Europe is big for us. US is big for us. Asia, we're developing still. Latin America, Australia. So we are present pretty much everywhere.
And you write across the classes of P&C?
Yeah, we do write the P&C classes, and the specialty lines are very focused, but we run this as a global business. So we do this centrally, writing the specialty lines on a global basis, and the P&C lines where we are in the market to be near to the clients, near to the brokers, in the local market, more often than not, with the local language as well.
Well, that reminds me of Gerling. There was always a local Gerling.
It was a very similar way at the time, having said, though, with not such a good ending.
but let's face it. I mean, lots of things didn't have great endings around year 2000, between 2000 and 2002. We know that.
But what I say is every surprise, every disaster will lead into opportunities afterwards. And I think the market developed nicely. New classes came out, specialty classes came out. And I think that was important for the market. And we'll have this going forward as well as we see new classes coming in and develop it. We need these scenarios to kick something off.
Yes, and obviously, you're part of a very large, recognizable global insurance group. Where do you sit exactly within that?
We are $3 billion out of bit more than 40 billion. So we're not the biggest percentage share, but I think we are a very good diversifier for the group. So I think that's a huge benefit, bearing in mind Liberty Group is as such a US operation to start with, having obviously a global remit.
Yeah.
But reinsurance can act in markets and can complement the book of business that we write in the US and that we write in the insurance side, because obviously we can leverage retention levels, and depending on non-proportional, proportional, we can enter markets where Liberty doesn't have a footprint, but as a reinsurer, it's an easy access to that. And it gives us a different clientele, a different platform in different regions of the world.
Presumably you still do write US business as well?
We do write US business as well. And we have offices in Boston and in Stamford. And that is mainly the normal US P&C class of business.
So as you survey your global domain, what's making you most happy? Perhaps you're looking at budgets and thinking, right, what's going to be my star performer next year? Where are you happiest with where the rating is, where the adequacy is?
Yeah.
And obviously, where that flow of business is, where that demand is coming from as well.
Yeah. I need to be careful what it is. It's a tricky question because depending on whatever I say now, I don't want to obviously step on anyone's toes
You'll tell
in our
everyone
own
else.
team, actually. But no, it's a fair question. And I'm very open in saying we want to develop the business, as I said at the beginning, on a long-term basis. And we have ups and downs in a lot of classes, pretty much in all classes. At the moment, we're looking at a pretty decent reinsurance market. So I think the cycle is pretty high, although I wouldn't call it a hard market. And we do see capacity coming in. So we see now more competition coming in, and probably we've passed the peak of the market. But we still want to develop the P&C side and the specialty lines. So I would balance those out over time. But our focus is specialty, because that's where we lead a lot of business. And the P&C lines will have to build gradually as we develop in different areas, because every country, every territory has a different nuance at this moment in time. And we need to manage this carefully by where we sit in the marketplace, at the same time not compromising the stability and the continuity that we're going to offer in these markets.
So I presume in the last couple of years, you've had really strong growth, and it's been it's never easy, but it's easier than it has been previously to grow in the last couple of years in that market. Presumably growth won't be quite so exciting as it has been the last couple of years.
Yeah. I mean, if I'm honest, we had a lot of tailwind the last 2 years just because of the rating environment. But a lot of people think, oh, now it's been 9 years and we are super profitable now and so on. We didn't need that, actually. It was more correcting and getting to a level that is sustainable. And we need to be careful that we're not damaging this too much, because we know our world is riskier. And I'm not talking about cat only with climate change and all these topics we've discussed a lot, but also the geopolitical environment. The PV classes are getting challenged, the trade credit classes. So a lot of things that we've developed over time will get challenged, and we need to be careful how we get into it. Cyber is another one. It's one of the most developing classes, I think, that we're seeing over the next couple of years. And it's a class that we do need to monitor carefully. We need to build out know-how. We need to build out people. We need to build out relationships and the product, and working out how you work the RDSs, the scenarios coming through the market as we see them, because CrowdStrike was a great example of what can happen. Fortunately, it didn't cause the biggest insurance loss, but it can give us a view of how the market is developing and what evolves from here going forward.
Are you more comfortable with cyber? I think it would have been fair for 5 or 6 years ago to say, well, yeah, obviously I might support this market in proportional basis. Some of the people I know are smart underwriters. I'll support them. They need support. They're growing. It's growing very fast. But also I'm slightly worried because I'm not sure we've got a handle on exactly where our aggregation is, what is an event, and all these things. Do you think now we've seen a development in the reinsurance market for a maturation? Do you think that's a recognition that a lot of that work has been done? Well, certainly a huge amount of money and time has been spent on better modelling, better understanding of the risk. Do you think we were at a stage where it's more maturing?
Hello, listeners. Are you attending Tintech London Market on the 4th of February?
As a reminder, Tintech London Market is the event about driving innovation, delivering successful change, and enabling the digital marketplace. Themes Mark and Dieter are discussing right now.
This isn't just another industry meetup. We're talking cutting-edge insight on leveraging AI, modernizing legacy systems, and creating agile operating models, as well as addressing the cultural challenges that come with transformation.
You'll hear keynote speakers Stephanie Ogden, CEO of HDI Global, on aligning culture and and Technology, and Chris Lowe, Group CIO at Hiscox, looking at leveraging new technologies, data and AI to transform traditional processes.
You can then choose from 10 breakout sessions and workshops most relevant to you, including case studies, panels, quick fire presentations, and a fireside chat with Sheil Sawney of Brit. Whether you're curious about AI applications or the future of digital trading, there's something for everyone.
Tickets are just $199 right now. Grab them before the introductory rate ends on the 20th of December. Search Tintech London Market to see the full agenda and book your place.
Don't miss it. Tintech London Market 2025. Innovate, transform, and lead.
It's maturing, but we're by far not at the end of the journey. And I compare it a little bit with the cat market, actually, when we started modeling that some 30 years ago, whenever that is, a long time ago.
Yeah.
And you think about what is a return period and how long does it take for a loss to repeat itself? And we've experienced it a lot on that journey. How often did we get it wrong? How many 1 in 100 years did we have in a decade or something like that?
Oh, yeah.
So that is developing. And even today, we're still developing this area because now we're getting all the non-model classes. We have more flood losses this year than ever. And we're focusing on the wind and quake perils. And now gradually we model all the other classes, but we'll never get this right. So I don't think I will experience the end of that journey. And cyber, just answering your question, is at the beginning of that journey. Yeah. So we don't know what we can expect.
And it's an unnatural peril. There's no La Nina, El Nino, or North Atlantic oscillation to be studied. It's a malicious threat that is always there, as far as we can see, unless you can physically go and arrest all of them.
Yeah, and you need to have enough fantasy to think what can happen, and how bad is it? And you have the optimist in there to say, actually, our systems are so secure, not that much can happen anyway. And you have the worst case people looking at this, so the whole world, the whole planet can stand still. It's probably somewhere in between. You need to work out a sensible way of monitoring exposure, but not being too naive to say it's a mind-printing money class.
Just because we all use Windows 11, how many billion people probably use that every day, then even if you found a vulnerability in every Windows 11, how would you have the resource to exploit that at scale? You would need a lot of people, even though you might be able to program a lot of AI to do some of it automatically for you. But even then, it's just like the biggest logistical challenge would be, how can I go and steal £10 from everybody in the whole world?
Yeah.
So it sounds like you're more comfortable with it, but still tempered.
Yeah, we're cautious about it. And I think the most important bit is we need to develop experience and expertise and think about how we grow it. So therefore, for us, it's an important one to develop and to grow, to put investments into the talent and into the way we model and price it and assess it. The benefit of reinsurance is always we're limited. You have a limit on pro rata, you have a limit on aggregate, stop loss, whatever cover you offer. At least it's a fixed limit you work with. You still need to work out how exposed that can be and what scenarios it can.
And I suppose when you get to something like an excess of loss product, almost like a cat excess of loss product, and now we've got some ILS, at that point, you do probably need a loss, don't you? Just so that the lawyers can argue about it, because you almost feel that they're bound to argue about it.
Well, the worst case, in my view, is always when it's unclear what you cover. And this is the biggest problem about being a reinsurer. It applies to all sort of different classes. Whenever there is a big loss, there is always a legal bit around it. So talking about Baltimore Bridge loss, it will be, we had that in COVID. We have lots of scenarios where it's not clear how the event is defined and what's covered, what's not covered and stuff like that.
It always amazes me after 30 years in this business of just how many ways can you define event? I thought when you go to the dictionary, there aren't that many definitions, but we keep finding new ways.
Well, people are very innovative when it comes to what's the best recovery from how to do it and how to collect whenever there is a loss. And I think we want to be clear. It's not that you want to avoid a loss. You just want to be clear. That's what you cover and that's what you pay. And you don't want to have a second argument later on. What I thought I'd cover this or I thought I don't cover that.
It's very hard to price for things if it turns out that after the event, it's something else.
Exactly. And you don't want to have, let's say, you offer a promise, you pay a loss, that's valid. And therefore, sometimes we are known to be pedantic in how we think about wordings and clauses, stuff like that. It's not to annoy people. It's around, I want to say that's the coverage you're giving. And if that loss happens, there's no argument about it.
Well, it's cold and dark and the Christmas lights have been turned on. So time to think about 1/1. What do you think will happen?
We get already the first signs, actually, of the travel of direction.
I'm sure you've been quoting and...
we've been quoting.
Have you firm orders? Or?
A few firm orders are out already, so not so much here in the London market, but internationally, globally, Europe is always, some areas are very early, so some bits and pieces are done. Very difficult to generalize across all classes and all regions, but I would have thought the market is in principle very disciplined, so I think we've learned our lesson from the past. I can't ignore the fact that people have seen good results over the last 1 or 2 years, and there's more appetite. So lots of people have more appetite, and we don't need to debate what it means if suddenly your program is overpriced and you think about, okay, what does it do to the pricing sort of thing? So there is more competition coming to the market. On the other hand, there's also more demand, depending on the class and the area. I do believe there is a fair, reasonable balance, but yeah, we'll see a competitive market environment.
And presumably, probably something more specific like US property cat, which obviously we always spend a bit of time talking about. Milton, did that kind of temper any enthusiasm for rate decreases?
If you are the risk taker, and you said you've been a broker in the past.
Yes.
If you're a risk taker, it's a very different view when you have a Cat 5 lining up and approaching Florida, and particular going into really highly exposed areas with the track where it did go at the time.
And you look at the north side of Tampa Bay,
Bay, for example, and if you sit there and see every hour more or less, you check where is it going. It's a different world than being a broker and saying, oh, that's good opportunity in placing business, whereas you run an exposure to that. But it tells us the value of the product that we are offering. And trying to come back to your question, both Helene and Milton were decent losses, proper cats, by far not as big as they could have been. So at the time, had Milton gone into Tampa, for example, yeah, it would have been a significant change to the market. And we probably don't envisage how much damage it could have done to the industry insofar as renewal. It would help back renewals. It would help back capacity and all the repercussions. But anyway, that didn't happen. So the reality is that the impact on pricing, on structures, is modest, to be honest. So I do believe the market has reacted a lot in the US. There's more to be done internationally, if I may say this, but in the US, the market has reacted a lot. And I think what the market tried to achieve, to be there for the large cat scenario, has happened. It has developed. So we are at a decent retention level, and we need to make sure we have the price for the product that we offer in line with retention and with the insurance and reinsurance balance, that this is the right level.
Would you say if there was any froth on the top of the market that's kind of enough to blow it away?
Yeah, I think people get alerted to say, actually, we're not writing this business to print money. We're here to write the proper risk. And if you look at all the investors seeing that, and it depends, we have different type of investors these days. You have the ones that sit back and say, well, there is an opportunity, and they're looking, if that's going to happen, I'll pile in big capacity. And you have others to say, actually, I'm here for the long term. I need to make sure it's a stable environment.
Your capital base is effectively permanent, and because it's a mutual.
We are a mutual company. So from that point of view, we are in a good space from where we are.
But you certainly don't have that temptation to be trying to maximize things here, and it is naturally long term.
Yeah. I mean, we do need to make a profit, and we want to make a profit, and we ideally want to be top quartile, but we are not here to grow for the sake of growing or to please and to pay out a dividend right, left, and center, and then next year we do something completely different. So for us, stability and long-term earning is more important than having jumps up and down, right, left, and center. So we need the stability.
And presumably in Europe also, the rain keeps coming down in buckets these days. Everywhere, wherever near a river you see, it's flowing fast.
Yeah.
And getting higher all the time. It's presumably a reminder in those clients that you're here, should be valuing that product.
I think it's testing the product. We can talk about floods all over the place at the moment, because we had that in Germany, we had that in Eastern Europe, we had that in Austria, we had that in Spain now, we had that in Dubai, we had it in Brazil. We had in Canada. We had floods all over the place, and we need to think about it. Do we price this appropriately? And certainly it's worthwhile to prove the point there is a product. And for some countries, flood isn't the main exposure. For Italy, you would have thought quake is the main exposure. For Europe, you think wind is the main exposure. But flood is the big exposure, and we have underestimated this over the time. And now we realize in certain areas where you would have thought, actually, it's not really a cat country. Well, there is cat exposure in there. And I think we need to get away from the point of saying, well, we just do this and it's run-of-the-mill losses. And eventually you get killed with it, and we don't know how to deal with it going forward. So we do need to address it, and we do need to have a proper product and a proper price for it. So that correction will need to take place.
Yeah, let's face it. I mean, everyone's exposed to flood because everyone's got sky, haven't they? I mean, there isn't a country that I'm aware of has put a big roof over the whole country. Not yet. Maybe.
Well, you think even
sometimes in Dubai it feels like it. But...
In Dubai, you would have thought it's all dry and sandy. You wouldn't be surprised there was a flood, but it's a flood-exposed country. It really is.
Yeah, no, absolutely. Yes, it's been reminded. You think it would drain away really fast, but of course, no. Water accumulates. There's rock, and there's
and the infrastructure isn't built to take that much water because they don't think they can get that much water. That makes it even worse. But anyway, that's an aside.
Absolutely, yes. Another thing that we're always debating, and we're right to debate because it's one of those things that will hurt us the most, casualty. I spent more time talking about this in the last 12 months with reinsurers.
Well, it's even a longer debate.
Yeah, well, it's the best kind of debate because it's a debate you can never really win. You never win or lose the argument, do you? You just it just goes on.
No,
so
100% agree.
This is sort of, yes, you can have an interminable conversation in a pub or bar with somebody about this. Where do you stand on this question at the moment? How adequate are things today?
Well, I would probably divide between US and international casualty business, and also would divide between different classes of casualty or generally long tail lines, because it's not casualty is casualty. It depends what type of casualty. Is it GTBL? Is it specialty lines? Is it D&O? Is it even motor is categorized as long tail business? And they all have their own challenges. But I think the one you're referring to is the US and the loss trends.
Yeah, I suppose it's the one that probably focuses most of the minds, and it's where you can make the biggest mistakes, I suppose.
Exactly right. And that is the most unpredictable one in the first place, because currently there is the debate about the loss trends and the price trends. And yet that market has grown a lot price-wise, lots of price increases. And we can debate now for the next 2 hours, is it good enough to cover all the loss trends, the inflation that we're seeing, and the sort of losses that we may see over the next 5 or 10 years? Because then we know the number and the expectation that you put onto your price trends is good enough or not. But it's a volatile area. It's a heated debate. No one has the right answer to it. You can be very conservative or not so conservative. But I think you need to have a prudent approach, because that line of business will only go one way.
And so where are you sitting on the spectrum of conservative to not very conservative?
We are pretty conservative, actually, and we are more conservative, I guess, than most of our peers. Whether we are conservative enough, it's a big question mark. I can't answer that question now, but I'd rather be on the conservative side than on the too optimistic side.
So, yes, it's not time to put your foot down on the accelerator.
Exactly right. Exactly right.
Would you say generally being conservative feels like you would never be the right time to put the foot on the accelerator too hard with that class?
I think even that is the class you need to have a stable view on, because ultimately you only know in 5 or 10 years' time, depending on the class, where you really stand and what area of the market you're in. I think no one would have said in the 18, 19 years, oh, this is the worst case, we're going to settle at 150, 200%, but they still write the business. People just didn't see it that way at that time. Today, we're all clever, but we need to make sure we have a certain stability, but you need to make sure how balanced casualty is within your overall portfolio, within the other lines of business, to manage through those cycles.
At least we've returned to a period of real interest rates. We're starting to see in P&Ls our old friend investment income actually returning after being absent for nearly 20 years. It's quite nice to see, isn't it? Does that encourage you a little bit more to say, well, long tail business is obviously long investment business?
Yeah, I know it's long investment business. And obviously it's nice from an investment point of view that you do generally make more investment on the returns. But I wouldn't necessarily judge casualty business for that, because if we did do that, there's probably a huge mortgage on the last couple of years that we need to pay off before we take benefit of any credit or positive interest going forward.
No, you're absolutely right. You're absolutely right. I mean, and the cash flow. I remember going to a conference once on something like D&O, and someone standing up and saying, well, you think it's a long tail, but actually it can be quite short tail in cash flow terms, because the lawyers weren't paying. As soon as you get a notification, okay, you might not settle for 7 years, but you've got lawyers' fees, the meter's running, and, you've got to keep paying them.
Exactly right.
Pay their retainer or whatever it is,
Yeah, exactly right. It's not just the premium that you can just sit there and invest for 10 years. That's a different story.
If the major cost is actually legal fees.
Which more often than not it is.
It's a large part.
It's a large part at least, yeah.
Yeah, no, it was an eye-opener to me to think, of course, it's not necessarily the indemnity. It's actually, it's the cost of doing that business. And, of course, the defence cost is one of the largest.
It's huge, but that's another broad story, is to think about that. Do we ever get the US to change the view of how the legal fees are shared, let's say, between the different parties? But anyway, that's a different topic.
I'm guessing that you're quite conservative. I think you've already said that you are, and, your long-term business. What about in your own outwards reinsurance of the last couple of years? Obviously, we've had a big reset in the whole reinsurance market, which obviously you were part of. But in terms of your own outwards reinsurance purchasing, your retro, did the availability or not availability of that, did it affect the way that you were approaching your own inwards reinsurance book?
No, I think the outwards is obviously something we do, and we purchase an outwards program. The inwards book is something we've been doing for a very long time, and that's one of the first classes we started to write overall, which is unusual, to be honest. But on the other hand, I believe the inwards book is a stable, solid instrument and class of business of the portfolio we have, and we are within pretty high in the ranking of offering that product. We're leading market, and we do, again, unusual for that class of business. But again, we do want to offer stability, and people need to trust in us that the capacity is out there whenever it's desperately needed. It's needed every year, but in difficult years, and it's not that long ago where that was a good example in 23. You might well remember how challenged the retro market in particular was, and hardly anyone was prepared to quote. And we stood up and said, no, we need to quote. We need to make and get this market moving. We offered pricing, we offered terms. It's always difficult to reset whenever reset is needed. Where do you pinch it? Where do you poach it? What message do you give? And hardly anyone wants to be the first one out. We're not shy of saying that and settling that. You can be wrong, but I think it was necessary to offer that stability and that at least starting point for the market for others then to follow suit.
In terms of Liberty Re, your inwards reinsurance book, your standard book, it didn't affect the availability or otherwise of retro. Did it affect the way that you approach that renewal again to your cedents, your standard insurers buying reinsurance from you?
No, definitely not. I know there is market that we're waiting for the retro market to come into play, and then some reinsurers have the excuse in brackets to say, yeah, the retro has gone up, I need to charge you more money, more or less. We don't operate that way. We do have a retro that we purchase, and that's a product that's out there, and that's with our partners, which we enjoy that partnership, but it's not dictating what capacity we can offer to our clients and cedents. That's the most important, that we need to have that stability. And fortunately, in our group, we can offer that stability.
Because you've got a big enough and well-diversified enough book that you could run it net, ultimately.
Exactly. That's back to your very first question, how do we fit into the overall group? Yeah. There is lots of, particularly on the international side, there's lots of complementary exposures that we wouldn't have otherwise. So therefore, that is a pretty healthy capacity that we have available.
Yes, the broker in me thinks, well, that's good. I could come talk to you. At least you'd give me an answer. It might not be the answer I want, but
exactly.
At least
it
I've
might
got
not
an
what
answer.
What you want to hear, but at least you get a response from us and you get an offer and you get capacity on the table if that's a continuation of the relationship that we enjoy. And we also enjoy that on a broader sense, so not just having the cat conversation or the retro conversation. We are known to be more a complementary reinsurer, to look at different class of business, to cross-sell and to have a wide range of products available, which helps cementing the relationship with our clients and brokers.
You've been involved in lots of really interesting things. The market's really innovating at the moment. There's so many interesting things going on, AI and all these other stuff. But when I was doing my research, it was quite prominent. You were involved in a lot of parametric.
Yes.
I've had real parametric champions and pioneers on the program, Descartes and a few others.
Yeah.
Really interesting what they're up to. Well, it's interesting that, you're admitted quite conservative, but also it's nice to see that you're supporting these new triggers, new ways of doing things. How far do you think it could go?
I see it as a complementary class to what we do. There's different parametrics covers out there, so not all of them are complementary. I'm not saying we do everything everywhere, but I think the parametric, so Descartes you mentioned, but there's others as well where we partner up with. And I think it's a nice addition and complement to what the insurance industry can't offer per se. So it's in areas where there's little modeling capabilities, in areas where it's probably a poor economy and there's no insurance infrastructure in the first place. So the governments, for example, would do that. Morocco was a good example, the earthquake in Morocco last year.
Yeah.
So that was a good example of saying, okay, how can cover be offered to a market like that to help building out infrastructure, to have at least the first dollars, and you pay out very quickly on those. So talking about the low casualty conversation we just had, parametric paid out within 2 weeks or so. You've got the money on the table and you at least can start rebuilding infrastructure. And the other benefit on parametric is exactly what happened, how bad the damage is. Do you need to help infrastructure if it comes to hospitals or so? We have sensors on there, they can tell you within a minute more or less, oh, the damage is really the building is collapsed or it isn't. So it helps also from a sort of infrastructure point of view, what other support you need to give rather than just the dollar amount paying out. That's what the insurance industry can't offer. What it can offer, another parametric product, is RLWs, the original loss warranty.
Yeah.
We just say, that's my 50 billion market loss in the US, for example. I'd call this parametric as well to a certain extent, but that is more or less in correlation with the normal traditional UNL retro reinsurance cover that you could purchase as well. So that's something which we look differently compared to the other example I was just giving.
Yeah, absolutely.
And maybe if I may add that, that's also the benchmark on PCS, which is the trigger point in the US for those market losses. It's quite interesting to see how that's been set and where PCS looked at Milton, for example,
yes.
and the first outcome, the second outcome, and whatever the third one, we'll wait and see what that will say. But that's a different dynamic, how you can protect your portfolio reliably on a given market loss and what trend you use for that. So that's an area where we're a bit more cautious.
Certainly it seems that this kind of trigger, it really suits the reinsurance kind of level where we're talking about very sophisticated buyers and sophisticated sellers. For me, I always think, I'm not sure how far could parametric cover go down into consumer insurance, because it would be very hard to explain or to work out that you're treating that customer fairly, for example, when you've got consumer type regulations and regulators all over you. I don't know about you personally. I can't see it going all the way down to home insurance or flood product for average guy in the street to buy, because I'm not sure they would understand the difference between having your 50 centimetre deductible and your 75 centimetre deductible.
Yeah.
That one might be the difference between, 1 in 10 and one might be 1 in 5,000 or something.
Yeah, it's probably not appropriate.
It looks
for
the same on my wall,
Yeah, it's probably not appropriate for you and me as a normal consumer, more or less, but it would be helpful for governments or for, I don't know, certain corporate companies, stuff like that. That would be useful. And that's where it is. That's what we're selling already now. And that's an area where I can see more development. So I think it has its place in this industry. To what extent it will grow needs to be seen, how it's been taken up, and also how the pricing works out to the traditional product versus a parametric product. So there is obviously the benefit of the quick payout and the direct knowledge, as I said earlier, on the infrastructural damage. But then it comes out, how much are you prepared to pay more, or do you get even less, depending how it's structured? So that's an economic that will need to find its way as we go on this journey. But I do see this as a good product. We're investing in it. We're growing it. It's one of our areas of growth as we look into the next 5 years of strategy.
Yes, probably better to have both blended together, have the core indemnity products for when you really need it, but the other one, because it pays out quickly, is quite useful for cash flow and that kind of thing.
Yeah, and it's an additional diversifier as well, because you do cover areas that you don't necessarily cover with the mainstream traditional reinsurance product.
Yes.
There are some that do clash, but there are areas which you wouldn't be able to track on a normal traditional way.
Yeah, because I always think of a parametric cover. I suppose it's particularly when they're infancy, they're effectively, it's an all risk. It's all risks of this number going to this.
Exactly right.
If the number is more than 9, I will pay you. And so whatever causes the number to go over 9 is covered.
Exactly. Yeah. There's no argument about it. Exactly, this is the trigger point. Whatever the number is, pick your 9. It's over 9, you pay. If it's under 9, you don't.
Yeah, but I suppose if that number 9 was 90% hotel occupancy, and then you suddenly realize that it's really affected by pandemic, you think, actually, I will have to exclude pandemic now.
The benefit on parametric
it's not all risks anymore, is it?
The benefit on parametric is that's clearly defined. You're covering quake, for example, whatever peril you cover.
Yeah.
That's what's the problem at COVID time, as you mentioned it, because you had all risks. You think you cover quake or you cover natural catastrophes.
After,
and then you have the debate.
If there's war or a big terrorist attack or something, we know that hotel occupancy will fall generally because we've had that with, first and second Gulf Wars and other things. We already know that these things happen.
Exactly.
That's really interesting. But yeah, we're going to watch this space, and I suppose we'll see where it takes itself.
Yeah, definitely. That's worthwhile to follow up, and it's worthwhile for us certainly to invest in it, to build out knowledge and to develop the product. And there is more to do. The world is big, and we have a lot of uninsured areas and regions and perils.
There's a lot of technology there as well, isn't it? We're talking about lots of data and other things, and in order to create a parameter, or sort of go back and create something that you think is a reliable loss predictor or a proxy for a loss. I'm talking about AI an awful lot with everybody. Any applications for the reinsurance? Yeah, in AI. Are you dabbling in any of that?
It's something we do have AI. We follow this. It's developing. We're not relying on it as yet because it's still in build-up mode. It's not 100% reliable, the responses you're going to get. So you need to question it. You need to double-check it. So I think it's in its infancy, but certainly it's a development area.
Yeah, effectively enhancing the underwriter's decision point, is that what you're using it for mostly?
Yeah, more for information at the moment. We don't use it as an underwriting tool per se, but it's more information gathering, and it's worthwhile to invest in it more and to see how it's developing. But yeah, that's probably takes a while till it's a practical approach.
Like a sort of agent that's reading a submission and saying, by the way, dear underwriter, have you noticed these 5 things that I've noticed?
Yeah, that could be, or just simply comparing wordings, for example. And it makes a very big difference to say it's excluded or it's not excluded. And sometimes you can split this through. The AI should pick that up straight away.
Yes, it's really interesting. It was one of the earliest applications of AI that I ever came across. It was almost 20 years ago with a law firm. There's a product called Reword, was, again, doing exactly that, machine learning and flagging up differences between treaty wordings. And there were huge differences, things like named rivers. Yeah. I didn't know that. I thought all rivers had a name, Yeah, there was something that was an unnamed river. Who knew?
Well, I never thought about that one, to be honest. But
But amazing how many discrepancies there are in wordings. I'm sure that actually, I think one of the first things that AI will be able to do would be to get rid of all those pretty quickly.
Yeah. Although I have to say, just as a definition, if I might add to this, coming to, let's say, contract certainty and clarity of what you cover or not, named or unnamed rivers. I mean, all the floods we've seen recently, the biggest one obviously burned a couple of years in Germany. the river you probably never have heard of, and it might be a small creek, which may or may not have a name, but certainly it wouldn't be in that definition. So I want people to use that going forward, actually.
We'll all give it a horrible name, that wretched river, the river that's now in my front room, that one.
Yeah, okay.
So Dieter, I think I've come to the end of all my questions for you. Is there anything you think we need to add that we haven't spoken about that we should have done?
Well, I have to say the reinsurance world is so big and so interesting. I'd had several topics which we could touch on. Yeah, we haven't spoken about the geopolitical environment, the PV world. We haven't spoken about marine, the specialty world, Baltimore Bridge. We haven't spoken about lots of things like that are warming up on the economic wars, I should say, so on the specialty lines. But to be honest, you can't cover the whole world. That's the good thing. That's why I enjoy working in reinsurance, because you have so many different topics. And I would say pretty much everything that's on the news will affect the reinsurance world in some shape or form. But I do believe we covered a lot of ground today.
That was good. That was always my pep talk when we advertised for a reporter job and realised we're in competition with all the other more sort of exciting sounding parts of the journalism world. And my job was really to try and enthuse this talented young journalists to try with us rather than, somewhere else that would seem more exciting. So, but, everything's on the night news you can write about the next day. There's bound to be a reinsurance or an insurance angle on there.
Exactly.
There's always, if there's money involved, there's always going to be something. So, and what you've said, yes, leaving a little bit more on the table is always a good thing. It means we can come and talk again, Dieter.
I'm sure we find more interesting topics, but thank you very much for having me. I enjoyed the conversation, and all the best to you and to everyone on the call. Have a good renewal season and good festive break, hopefully. Thank you very much.
Thank you.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this program. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance is produced in association with Advantage Go. Release your underwriters to underwrite with Advantage Go's underwriting platform. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.